So over the past few weeks on this channel, I've been quite positive, right? I've told you about my favorite stocks on the Canadian side, on the US side, some companies that are undervalued at this moment. But today I want to go back on the other side and help you to avoid lose money. There are some investment bias, some mistakes that we are making that are kind of like invisible mistakes. We don't really realize that it's a bad thing for a portfolio, and yet we still do it. So today we're going to cover 3 of them. I'm going to tell you about why you're doing this, how it hurts your portfolio, and how you can fix those invisible mistakes. So let's get started with the first one. Waiting for a pullback. And that is a classic mistake most investors do because they're thinking, oh, the market is trading at an all-time high. I'm just going to wait. And once it goes down bad enough, I'm going to deploy all my dry powder. I'm going to buy everything at a very low price. So why are we doing this? Well, quite simple, right? We want to buy low and sell high. So when we are at a high time, well, we're just thinking, not the right time to invest. We want to have a good deal. We want to have more value for our bucks. And we always have this friend of ours, like brother-in-law, it has to be the brother-in-law, right? That will tell you at a Christmas party, oh yeah, I put all my money on the energy sector at the end of 2020 and then I made like 500% returns. Yeah, that kind of makes sense. I mean, every time that we look at the market, we do have those downtrends and eventually it goes back up. But how realistic is this strategy? So when you look at the crises that really happen, like bear markets, you see them in red on this graph for the S&P 500. Well, first, you kind of notice that they don't happen that often since 2000, right? It's like the tech bubble, then we have the financial crisis, and then we have the COVID, and a small one in 2018. And just think about that. Did you know that in March of 2020, it was the perfect time to invest in the market? Did you know that on Boxing Day, December 26, 2018, this is where you had to deploy all your money? Because if you had waited until January or February of 2019, you lost like 20% on the table. So it is incredibly hard to actually capture those wins when you're trying to invest at the bottom of the market, because when you are at the bottom of the market, the narrative is quite bad. Like everybody will tell you it's going to go down even further, even in 2022, right? So the stock market was down and then everybody thought 23 is going to be even worse. Well, guess what? 23 was positive. So far, 24 is positive. So waiting is literally a losing game. It's actually quite risky because while you wait, you're not making any money. And chances are every single day that you're not in the market is actually a day that you're losing money. Now, if you don't believe me, I have another graph for you. So JP Morgan conducted this study, which is quite interesting. From 1988 till August 2020, wanted to see what's the difference between investing at any day in the market versus investing at the all-time high. So completely the opposite of waiting for a market bottom for a pullback, right? Well, if you see, like as you can see on this graph, if you invest at the all-time high, after 1 year, you're going to be better than if you have invested in any day in the market. After 3 years, still better than any day of the market. And after 5 years, still better. And you want to hear something even better than that? Well, if you invest at any day in the market, 83% of the time, you will show positive return after 12 months. If you pick the all-time high, it goes up to 88. Like that doesn't make any sense, but this is how it goes. So again, time in the market instead of market timing is crucial when you build your portfolio and you're in the accumulation phase. Now, how you can fix this? Well, first, you need clear rules. You need an investment thesis that works with financial metrics. And there you go. You don't need something super sophisticated that will ask you to go down into a lot of research, read a lot of documents. Keep it simple. I mean, if you don't have the time to follow the market, you can just go with ETFs and that's going to be fine. You invest in an ETF that is aligned with your investor profile and then boom, you don't have to ask yourself any question. Is the market high? Is the market low? You don't have to care. You just invest and time in the market will do the magic. Personally, I'm passionate about investing and I decided to focus on dividend growers. So I will follow all my stocks, roughly like 30 companies that are almost equally weighted, and I focus on the dividend triangle. So I'm looking for companies with growing sales, growing earnings, and growing dividends. When I found those, I buy them, I keep in my portfolio, and I review my investment thesis. So the reason why I have this company, along with the dividend triangle, making sure that the revenue keeps on going up, the earnings keeps on going up, and I keep on getting rewarded as a shareholder. When this happens, I don't ask myself any other question and I move forward. So far, it has paid off, so I'm super happy with my strategy. But the key point here is not to necessarily follow my strategy or to go with another sales strategy, but to find yours, the one that you have conviction with. Now let's move on with number 2, focusing on the yield, or should I say obsessing over the yield. Why are we doing this? Well, most of the time we're talking about retirees that just love napkin calculation. When I say napkin calculation it's just like super easy. You have $1 million, you need $50,000 a year, and then you invest at a 5% yield, and then boom, you get your $50,000 back every single year. You don't need to have a sophisticated approach. I just told you, keep it simple. That sounds like great, right? The problem is, while you're getting that income and while it is comforting and you feel that it's guaranteed, the problem that's it's not. And the second problem is you may be ignoring total return, meaning that you leave a lot of money on the table. But I already did a lot of the videos about telling you how it's important to consider total return. Today, I really want to focus on the dividend part of it. So we're going to forget about the total return today, and we're just going to focus on the income because this is what you focus on, right? So here's the deal. The higher the yield, the higher the risk. And even worse than that, you kind of forget also about the concept of inflation. So just to show you what's happening when you focus on high yielding stocks that are not able to grow their dividend. So while prices increases, your income is not growing as fast as those prices. So meaning that you're losing buying power year after year, and eventually those kind of companies like AT&T or Northwest Healthcare Properties could also slash their dividend. And when this happens, you lose your source of income on top of having a big hole for your capital because, of course, the stock price followed the dividend and both of them went down big time. So this is what's hurting your portfolio, is to focus on that income, ignoring inflation, ignoring the health of the company, and just thinking, as long as I receive a lot of a percentage and yield, I'm good. Well, you're not going to be good for a long time. It's not going to be sustainable. And you want to know why it's not sustainable? Let's take a look at a real life example. So this is the dividend triangle for Transcontinental. It is a printing media business that bought a packaging business in the States. And as you can see, the revenues are stagnating, actually slowing down. The earnings are going down all the time. And then guess what? They stop increasing their dividend. And as you saw, the stock price goes down, the yield is higher up. And of course, right now, Transcontinental is offering you an amazing yield. And then you're thinking, yeah, that's great. Well, when you look that the company cannot find any ways to grow their sales and they're actually making less and less profit year after year, do you really think that the dividend will continue to be sustainable for a long time this way? So going forward in the next few years, Transcontinental will have two choices. Either they will shift magically the business and start to be a growing business again so they can continue to pay that generous yield, or they will cut the dividend. There are like no other ways. It's like saying, oh, I'm going to keep on increasing my budget. So buying a new house, buying a new car, but I'm not going to get any pay raise. Actually, I'm going to get demoted and make less money year after year. Do you really think that you're going to be able to manage your budget for a long time? Of course not. And this is why it's dangerous. So now, how can you fix this obsession over the yield and over the income? Well, I would suggest that you download my Dividend Income for Life guide to see the comparable between high yielding stocks with poor growth perspective with low yield, high growth companies that are actually not only safer, but more performant. And you will notice that over 24 companies that I've selected that had a high yield 10 years ago, and they were quite popular. So I didn't cherry picked. most of them were not able to match the inflation with their dividend. Some of them cut their dividend on top of that. While if you go for total return approach while selling shares, getting the dividend, and using a cash reserve to make sure that you're not selling stocks at the bad time on the market, you will have a better retirement. All of this is explained in the guide. There's also an example on how to build your portfolio and how to make sure that you prepare it for your retirement and that you have your cash reserve. So you can go on dividendstocksrock.com/income. So the link is in the description below. The guide is free. You just have to put your email and you're going to receive it. Now let's move on with number 3, holding too many stocks. A lot of investors will argue with me that they rather invest in 75, 80, 100 companies because they want to be well diversified. Unfortunately, when you look at their portfolio, it looks like this. Like all Canadian banks or all tech stocks or whatever sector you want. But when you have so many companies, what you do is not diversification, but rather diversification. You're just adding more and more salt to your soup. So you have table salt, you had gray salt, you have pink salt. Well, you're just getting your soup saltier. You're not improving your diversification. On top of that, the other problem that you may have, if you really do a good due diligence and you have like 75 companies that are all in different industries, well, they won't move the needle because each of them will be roughly 1% of your portfolio, maybe less than 1%. So if they double in value, you're not going to feel it. If they crash and burn, you're not going to feel it. So you may have the fear of losing money, which I understand. But on the other side, unless you have like a lot of time and it's your full passion, tracking down 75 to 100 companies every quarter, reading the quarterly earnings, listening to the earnings, watching the presentation, like doing that follow-up, chances are you're not going to be able to do that for 75 stocks every 3 months. That's pretty much like a full-time job. Even professional portfolio managers don't do this. And to be honest and to be fair, if you're up to 75, 100 stocks, you might as well just pick an ETF. You're going to have pretty much the same exposure with zero work involved. So if I was going to build a portfolio with so many companies, I would just sell them, buy an ETF, and just chill. That could be a pretty good solution too. So just to summarize quickly, the first investment mistake that you make is you wait before you buy. You don't know when the bottom is, and actually staying invested is a lot more profitable. The second one is focusing on the income. The more income you want, the higher the yield, the less sustainable your investment strategy will be. And that is a big risk. Actually, download the Dividend Income for Life guide to understand what I'm saying here. I know it's thought provoking, but the numbers don't lie. And the third one is you're holding too many stocks because you're afraid of losing money, but in the end, you're probably better off with just an ETF and spending all that time doing something else than monitoring 75 quarterly earnings every single quarter. All right, guys, I hope that you have enjoyed this video. Let me know about your favorite investment mistakes or bias that maybe you do, maybe you solve. Let me know the solution as well in the comments. Give me a thumbs up, subscribe to the channel not to miss the next video. And until the next Thursday, don't forget to stay invested.